Hello all, thank you for joining us. We are excited to bring a closer look to one of our most anticipated launches, Franklin India Multi-Asset Allocation Fund, which begins July 11th, 2025. In today's dynamic market environment, investors are increasingly looking for well-rounded solutions which can potentially give them balance between growth and stability. This fund is thoughtfully designed to just do that, combining equity, debt, and commodities into one single portfolio, which aims to deliver diversification. It also gives you reduced volatility and at the same time supports better long-term wealth creation. To help us understand the strategy, the positioning, and the market outlook behind this fund, I am delighted to have someone who truly needs no introduction, our CIO, Janakiraman R. Hey Janki, welcome.
Hello Avnish, good morning to you.
Good morning Janki.
It's good to be back in Bombay and especially good to be back for an NFO for a product that appears to hold a lot of attraction.
Great, we are equally excited Janki. So let me get straight into the fund in terms of if you have to look at the whole context of launching this fund and we look at year 2024-25, both if we have to look at we have had positive events, we have had negative events across domestic and global markets. So what is your current outlook in terms of the volatility that's around? What should investors look in terms of their approach? And do you think a multi-asset solution fund can really help investors navigate this volatility?
I'll take a few words that were mentioned in your question, Avnish. Positive events, negative events, and volatility. So what we have observed in the last 2 years or so is that both positive and negative events introduce a lot of volatility into the market. And this is one that investors want to manage very well. Given a choice, obviously investors want to avoid volatility as much as possible. Let us just look at what kind of events have happened in the last 2 years. See, on the positive side, Indian growth stands as a beacon if you compare it with global growth rates. So the resilience of the growth rate is positive. I would say that the second positive is we did have a slowdown after that post-COVID surge, and the slowdown was visible somewhere towards the third quarter of calendar 24. Now that seems to be behind us, so growth seems to be recovering. That is another positive. Okay. The third positive is that all our macro numbers are looking very strong, whether you look at a suite of metrics, inflation, twin deficits, FX reserves. This macro position also looks much more attractive. So I would say that this is again a positive development. But on the other side, you have quite a bit of adverse developments that we have seen over the last, especially over the last 2 years. To start with, geopolitical tensions have now started to escalate well beyond where they started. So in many parts of the geography, global map, now you see a heightened level of geopolitical tensions, and that introduces a lot of uncertainty in terms of investors' risk appetite, in terms of pricing volatility in the commodity markets. That is one negative. The second negative is the whole lot of volatility that is now visible in US economic policies, especially in trade policies. The tariff levels, the levels of the tariff, the manner in which these tariff policy decisions have been continuously modified, all of them, that also introduce an element of uncertainty. So both of them, both positive and negative, have led to heightened volatility in the markets, which is visible if you look at the returns. To just convey this point, let us just divide the last 18 months into 3 time blocks. March of 24 to September 24.
Okay.
September 24 onwards up to about February of 25 and Feb 25 to now, let's say towards the end of June. The returns are quite distinct in these three blocks. The first and the third block had good returns. Second block had weak returns. And these returns were influenced both by local as well as global factors. And both could be either positive or negative. So a lot of volatility. I think this is where the utility of a multi-asset shines very brightly. If you look at most of the investors, what they want is returns, but also with a lesser degree of risk. I don't see too many investors want to focus only on returns, ignoring the amount of risk they take on board in that quest for returns. So risk-adjusted returns is what now a lot of Indian investors are looking out for. I think in this context, multi-asset product looks very appealing, primarily because it diversifies the risk by investing in at least three asset classes. And the most important thing is the returns of these asset classes have a lesser degree of correlation.
Okay.
That is what reduces the risk. It reduces the risk in the form of volatility. Volatility is actually a financial concept. Much more importantly, what an investor can realize, feel, is the drawdowns that they suffer during market downturns. A multi-asset product also, to some extent, reduces the drawdowns during those tough times. So that is one way in which it helps the investors manage their risk. So I think that is the attraction that multi-asset products bring to investors, especially during times of such volatility.
Great. I'm sure investors would be looking for such an opportunity which can come in terms of helping them to navigate and reduce volatility in such uncertain times. So, Janki, thank you for setting that context. I think if you can also highlight to us in terms of this whole category, multi-asset allocation as a category, how it's shaping up, and there are other funds also within the hybrid space in terms of if you look at a balance advantage fund or a hybrid fund or a fund of funds. So how do you see this category really scaling up?
So two parts to your question. One is how this category has performed or has grown in the Indian context, and the second is how does this category differ from the other hybrids. I think part one, clearly the numbers are quite strong. The numbers tell their own story. If I remember the numbers right, this category has now 25 plus schemes. It's a relatively new category in the sense out of this 25 plus schemes, about 20 were launched over the last 5 years. So It's a relatively young category, though we have a few products which are much older. Inflows into this category have been quite strong, consistent and strong, indicating that the value proposition that this product offers, it has found good traction with Indian investors. So that is visible in the consistent inflows that this category has seen. And it's put together, it's a large category. This is one of the categories where Franklin did not have a presence so far. So obviously that is the reason why we want to address that gap. Now to your second question as to how it differs from the other hybrid funds, it is primarily through the introduction of the third asset class, which is commodities. So we have our own existing hybrid fund, the Balance Advantage Fund. I think it's going to complete now 3 years old. Now in a Balance Advantage Fund, you have only two asset classes, equity and fixed income. The introduction of the third asset class, which has a much lower correlation with equity, I think that allows the portfolio manager a scope to bring down the product volatility significantly.
Okay.
Much more than what a combination of just equity and fixed income can achieve. So that is the role which is played by commodities. There are certain differences also in way in which this particular multi-asset product itself can be constructed. There are some ways in which our construction may be a bit different from the existing products. That of course we'll talk about later when we'll have appropriate questions in that direction.
Sure. And thanks, Janki, for I think telling us in terms of how this category is important, because what we see is there are so many investment options available for investors today, and like we discussed within hybrid itself, we have different options. But clearly, while you called out some of the advantages that a multi-asset allocation fund may have compared to others, but anything from a product construction perspective which sets this fund apart from the other asset allocation strategies?
And here you're talking about our fund.
Our fund.
So the way in which I want our partners to visualize this product is that the return comes in 3 different levels.
Okay.
Now you have, and this is true for any of the products. So you start with the basic return will be the risk-free rate. And on top of that, you also have the returns that comes through the strategic asset allocation, which is popularly called as the beta returns. That is based on the absolute risk that the product assumes. And this will be based on the way in which it distributes the allocation between the asset classes. Now, there is a way to add value through the strategic asset allocation pattern itself. That's the beta return. The third level of return comes through active risk. For example, there will be a strategic asset allocation plan. As a portfolio manager, can I take calculated risk in terms of deviation from that strategic asset allocation plan, what you call as dynamic asset allocation, and that adds the third element of return called the alpha. And it is our intent or our conviction that we can add risk through the third level also. As it is, the product will have, when you just compare the benchmarks itself, NSE 500 on the one side and the benchmark that we have proposed for this product on the other side, that should illustrate very well the advantages in those first 2 layers of returns, which is the risk-free rate and the beta returns. The third part is potentially if this alpha return also turns out to be positive, then that can add another layer of return, as I just told you. Now, how we plan to address that third level of return or the third layer of return, the dynamic asset allocation will be based on certain macroeconomic parameters. So it is a quantitative model that we have designed. We have backtested this model, and based on this macroeconomic parameters, on a monthly basis, the asset allocation will change. So it will deviate from the strategic asset allocation level. So that's the dynamic part. I think it is my belief that we can add positive value to the first 2 levels of return. So that's how this product is constructed. Very importantly, again, let me reiterate this point. The attraction of this particular category, and of course our own Franklin multi-asset product as well, is in terms of risk-adjusted return.
Yeah.
What you will get over a longer period of time are returns which are potentially not very different from equity returns, but at a significantly lesser degree of volatility. So today now many of the investors are also aware of the concept of risk measured through metrics like Sharpe ratio. So the Sharpe ratio of these such products tend to be much better. So which means that for the same risk appetite, the investor can actually take a much better exposure, much larger exposure to this fund. So that is how I would say that, that's how I would describe the construct of this product.
Great, I think so. I think the point that you highlighted in the third part of saying while it is an asset allocation strategy, but I think the difference can come in from being active and dynamically managing the whole asset allocation in terms of looking at the market environment.
I agree.
Great. And let me just carry on from here. So while we talked about the concept of the product, but another thing which we believe works as an asset allocation strategy, And while we keep saying, or we looking at investors' expectation is to stay invested for a long period of time, and unnecessarily do not look at rebalancing the portfolio. But do you believe that if we are doing a periodic review and rebalancing the portfolios in terms of your asset allocation, does that also make a difference in terms of the wealth that you can create over a longer period of time?
I would definitely agree with that. But before that, let's take a step back. So, this also means that the investor has a reasonable idea about what his return expectations are.
Yeah.
And based on the return expectation, he develops a appropriate asset allocation model. Because return expectations and risk appetites vary across investors.
Agreed.
So, which means that for a particular combination of those two requirements, you design an optimal asset allocation pattern. Now, this is the first step. Now, if there is a reasonable amount of clarity at this level, then subsequently rebalancing becomes very essential.
It does.
It does. So, let's assume that the investor has a fairly long time horizon and remains invested in this particular portfolio for a long time, let's say 10 plus years. Quite clearly, in the course of those 10 years, the portfolio contours will differ quite meaningfully from the asset allocation pattern that he started out with. So, which means that the attributes of the portfolio, or at least what he expects from those portfolios, will not match. So, he would have started out with a 65% equity exposure, and in a well-performing market like what we have seen in the last 5 years, the equity allocation probably from 65 would have become about 80 or 85. So the risk in the portfolio is now very different from what he has in mind. This calls for a rebalancing. And much more importantly, during points of extreme stress in the market, and these are not very frequent, mind you, probably you'll have 2 or 3 such points every decade or so. Those are the points where rebalancing becomes very, very critical. And if you miss rebalancing during those points, they have a fairly meaningful impact on the long-term potential returns from that portfolio. So, to answer your question, I think first of all, we need a reasonable idea about return expectations and an appropriate asset allocation that matches that. Yes, starting point. Once you have the clarity to answer that part, I think then rebalancing is definitely required. One of the advantages of this multi-asset product also is that so the rebalancing can be done either at the client's end or within the product itself. Yeah. So you do it within the product. Some of the advantages are that you do it in a more methodical manner. Because of doing it in a methodical manner to a large extent, I would not say 100%, but to a large extent, you take away the behavioral shortcomings from the decision making. And of course, once you do it within the wrapper of a mutual fund product, the tax friction in terms of asset allocation also goes away. So, asset allocation and rebalancing are essential, and especially if the rebalancing is done within a mutual fund product, then it becomes far more, I would say, effective and productive for the investor.
Great, thanks. So, let me again allude back to the differentiation that you were talking about, the multi-asset and the introduction of the third asset class, which is commodities. So, can you maybe spend or shed some more light in terms of how important is the role of commodities in this part of the asset allocation fund, and also if there is a view that we have in terms of how the commodities will perform given the whole macroeconomic environment that we are going through maybe another 2 years, 3 years down the line?
Let me be clear here, Avnish. In our construct, the role of commodities is in their low correlation with the core product, which is the equity allocation. So the low correlation with equity, it helps me to dial up and dial down the equity exposure at certain points of time and shift the allocation to commodities during that point. So the attraction of the commodities is in their ability to take the allocation away from equities for some periods of time, not necessarily in their returns per se. This is the basic observation. On top of that, if you have positive returns coming from the commodities, it adds to the returns. Obviously, I'm not going to let go of that opportunity. But to just reiterate, the attraction of commodities in our construct presents itself through the rebalancing opportunities, where I can dial up and dial down the equity exposures at appropriate times. That's number one. Number two, of late, with the expansion of the financial markets globally and increasing sophistication, commodities as an asset class have now become mainstream investment opportunities. Okay, which was not the case maybe a long time back earlier, which means that they're also now in the consideration set for most of the investors. Consider the background of global monetary policy ever since GFC. So there's been a massive increase in terms of central bank reserves, the money supply. In an environment where you see a large explosion in the supply of fiat money, store of value like gold, it definitely it increases in terms of confidence in the investors' mindsets. Case in point is the fact that post GFC, even global central banks have accelerated their purchase of gold as a part of their reserves. So in this environment, definitely gold has that attraction as well. Now, as far as the other commodity that we are going to consider is silver. As far as silver is concerned, it has much more industrial use when compared to gold. And one of the areas where I think silver is required is in terms of producing renewable energy equipment, renewable energy assets rather, that and some other industrial applications. So which means that with the large growth that one is seeing in terms of renewable energy capacity, the demand for silver is on a very firm footing. And on the other side, the supply of both gold and silver are relatively finite. They don't respond that quickly to increase in demand. So the demand supply dynamics in these two asset classes look quite favorable. But I'm not an expert in terms of commodities. Again, going back to my original observation, as far as this product is concerned, the main attraction of commodities, especially gold and silver, it lies in terms of their low correlation with equity returns. And we intend to exploit that correlation very effectively in this.
But having said that, we will have an active part of commodities in the asset allocation of the product.
Of course. So the way in which this the asset allocation boundaries have been designed is that commodity exposure will be varying between the minimum level of 10% and it will go up to a maximum of 25%.
Okay.
To start with, the aggregate commodity exposure will be between 10 and 25%.
Thanks, Janki, for giving us the context on the commodities and the role that it will play in terms of the whole asset allocation strategy, because it is a multi-asset fund. But you also, during our conversations, alluded that equities will continue to be one important asset class for this fund as well. So just wanted to maybe allude to the philosophy that we have as a fund house in terms of our equity team. How has our equity philosophy played out over the portfolios, and will that the same philosophy be also part of the current fund in terms of managing the equity allocations?
A very apt question, Avnish, because in this conversation and these discussions about commodities, we tend to overlook the fact that the core of this product remains equities. And absolutely what you said is right, that our investment philosophy, which is visible in most of our flagship funds, the same investment philosophy will be applicable in this case as well.
Okay.
And what is that philosophy? Our objective in making equity investments is try to identify businesses which have what we call a sustainable quality. Now, there are different metrics that we use in order to objectively measure whether the businesses have not only quality but the ability to sustain that for a long period of time. On top of that, we also want businesses which can produce growth. So sustainable quality plus growth, that is our mainstay, core philosophy, and that is our mainstay in terms of the corporate universe. Now the thing is, such businesses are typically not available at a very cheap valuation. So what has helped us is, in the past, is identify such businesses, buy them at fair valuations. Of course, if you get the opportunity to buy them at cheap valuations during those extreme stress points, well and good, but otherwise buy them at fair valuations and try to make returns by the underlying growth of the earnings. That will be the equity investment philosophy for this case also. And that is one more way for us to add alpha to this product. So earlier I mentioned about the strategic asset allocation. On top of that strategic asset allocation, if I add better quality security selection to that product, then the security selection can add an alpha return to this product, and which we hope to deliver positive alpha. This is a philosophy that has held us in good stead, like I said earlier also, over the past. It suits investors who want to invest for the long term, who want to look at returns through the lens of risk-adjusted returns rather than just pure returns. And this is again a philosophy that has been proven and tested across different phases of the cycle. So we also want a philosophy that is effective in a normal choppy market, in a weak market, in a relatively strong bull market. In all these market phases, this type of a prudent philosophy focused on good quality businesses, I think it's quite an effective philosophy, and that's what you will see in the multi-asset fund as well.
Great. I couldn't agree more. 30 years of managing equities and creating wealth. We have a long time tested philosophy which has worked well across our products.
Absolutely.
Thank you, Janki, so much for providing all these insights in terms of the new product. Like you said, we are excited with the launch. And what my key takeaway is, obviously, this is a product in current market volatility can help investors reduce volatility. And last but not the least, I think the alpha creating opportunities that we can have through our well-defined equity philosophy will continue to provide the right impetus to the fund. So thank you so much, Janki.
Very well summarized, Avnish, and thank you for the opportunity. And I do hope that investors take advantage of this wonderful product.
Great. So our NFO opens on 11th of July, like I said, 2025. The NFO closes on July 25th, 2025. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.